Well, let's dive deeper into the action as we see the grind higher at the close. Abigail, what were you watching?
Well, of course, with the Fed next Wednesday, I'm thinking about bonds, the 10-year yield in particular. Let's take a look at this long-term chart because the 10-year yield, the last 4 weeks, it has closed down 3 out of those 4 weeks, or excuse me, it has closed higher 3 out of those 4 weeks, telling you that bonds are sliding into the Fed, perhaps making the case that the 25 basis rate cut that's expected is priced in. This is a long-term chart. You see the great bond bull market here. What I'd like to point out is there's 2 different trend channels here. You can see the 10-year yield right now bouncing off of the higher one. If the 10-year yield, Sarah, holds about 2%, let's call it, it suggests that any rate cut or future rate cuts may be priced in to some degree, as has happened in the past with QE. But if below 2%, look for a significant move lower, right on that critical line, Sarah.
Thanks, Abigail. Absolutely everyone is watching the Fed next week. But also we have many more earnings coming to the stage. But so far, if you zoom out and you look at earnings from above, second quarter earnings have looked pretty good. About 3/4 of companies have beat expectations. We're now tracking to see flat growth. We're no longer expected to see a decline in earnings growth for the second quarter. However, if you look ahead, things have been a little bit bleaker. As you can see in this chart, there have been 35 companies that have revised guidance for the third quarter, the next quarter. And many of them, 60% of those companies have actually revised guidance lower. And that share is the highest in data going back since at least 2011. So that begs the question, if the Fed cuts, is it going to be the end all be all? Is it going to save everything? But also, if we continue to see this trend progress going forwards, is it going to be an issue for companies?